Hello, everybody. I'm happy to be there. So, topic of this evening, how to sustainably navigate in this environment. So this is a pretty tricky question because, as you know, there's lots of moving parts in this market. So we'll try to extract some data that we could be useful and can help you to navigate in this market. It's true regarding macroeconomic environment, there's pros and cons, and we could see some green light. For me, the most important green light is inflation. Inflation has been clearly, over the last 2 years, the elephant in the room, clearly. And today, the good news is if inflation is easing and is slowing quite faster. I mean, look at the last number we saw in October. In October, the CPI inflation in Eurozone fell to 2.9%. This is a good news for consumers, of course, for corporates, but also for financial markets. Why? Pretty easy. On the left-hand chart of this slide, you can see the average PE of the market. You know that the European market is pretty cheap, 11.7, but it has never represented a trigger. But the right-hand part of the slide is pretty interesting. It's the correlation between inflation and market PE. And as you can see, when we have a pretty high inflation, market valuation is pretty low, 12 times. So in line with current market PE. But in a, I would say, slowing inflation, below 3%, valuation of the market, on average, over the last 30, 40 years, it's close to 14 times PE, representing 25% upside on this current valuation. So green light for this macro indicator. Unfortunately, there are some yellow indicators, mixed bag indicators. First one is European corporate margins. Clearly, once again, on a very long track record, you can see that European margins are all-time high. So it will be very hard to surprise on the upside. And as you may know, companies have lots of headwinds. We can notice, for instance, wages inflation. All things being equal, plus 1% wage inflation represent a negative impact on corporate EBIT of roughly 1%. So I would say orange light for this indicator. The second indicator that you have to monitor very closely is employment. Because in order to know whether it is just a slowdown or a recession, we will have to follow employment. And as you can see, when we look at the European manufacturing PMI on the Eurozone, clearly employment is not going into the right direction. So one advice to follow very carefully this indicator. And for me, there's a red light. Clearly, the red light is what I have called the wall of debt. We know that in the years to come, amount of money have to be refinanced in the next 2 years. Look at the chart. In 22, there were nothing. This year, yes, a slight amount of money to refinance, and in 25, 26, it will be massive. 25, it represents 3 times the level we saw this year. And companies won't wait the end of 24 to refinance. They will begin to refinance at the beginning of next year. It won't be an issue for healthy balance sheet, healthy corporates, because they have lots of money and 2 or 3 basis points more to refinance. It's not a concern. But for more leveraged companies, clearly it will be an issue. So you will have to be very careful, to be very selective when you pick up companies. So, in this macro environment, what can we do in this market? I have 3 advices. Advice number 1, to focus on high-quality stocks. What do we mean by high-quality stocks? Let's take an example of our European flagship at Edmond de Rothschild regarding European Equities, Euro Sustainable Equity. This fund has an investment process to invest in high-quality stocks. What do we mean by high-quality stocks? It's companies that have both high financial qualities and high extra-financial outlook. When we speak about financial qualities, we focus on the visibility of the business model, meaning companies that have strong operational leverage, healthy balance sheet. They often operate on sectors with high entry barriers. At the end of the day, it's companies that have pricing power. On ESG, we rely on our internal database. We have 4 people dedicated to ESG who follow roughly 45 criteria. And this is really important when you manage a fund to be exactly what is behind every number of your spreadsheet. We have full access to management. When we don't have any numbers, ESG numbers, we don't hesitate to come and visit companies in order to build our model and to assume exactly what could be the future for these names. So what we do that is to mitigate risk, of course. And in this environment, uncertain environment, clearly it's super important. What does it mean in terms of financial ratios to invest in high-quality stocks? As you can see, on lots of different ratios, that means to be better than our benchmark. It's true for margins, it's true for return on equity, it's true for 2-year EPS growth. As you can see, in this portfolio, Euro Sustainable Equity, we have a 2-year EPS growth, which is almost twice the level we can assume for our benchmark. But for me, the most important ratio is the last one, the percentage of stocks in net cash position. Because I told you that refinancing will be key in the years to come. So with these kind of companies, 29% in our fund are in a positive cash net position. Clearly, we will sleep better at night because it won't be an issue at all for these names. Regarding performance, yes, we have a pretty good track record over the last 5 years, but above all, we have a volatility which is lower than our benchmark. So at the end of the day, we have a Sharpe ratio which is by far better than our index. Idea number 2, to focus on companies with a standalone strategy. What do we mean by a standalone strategy? We have identified within Euro Sustainable Equity 2 categories of companies. It could be that we call innovative companies. Very, very easy to understand. It's companies that have launched a new product or a new service. These companies are enjoying pretty strong structural growth. And most of the time, when you pick up profitable companies, that means that EPS have superior growth. So interesting for shareholders. Or it could be that we have called early adopters. That means legacy companies that have understood before the competitors the need to evolve towards more, I would say, favorable growth. It could be through an acquisition, a new capex plan, a disposal. But at the end of the day, the market has to recognize this higher growth and should, I would say, award it by higher multiples. So once again, it will be positive for our shareholders. So I won't have time to share with you lots of stocks that we own in this portfolio, but it's just to highlight that we are not necessarily investing in just technology stocks or mid-caps or companies that are involved in some specific sectors. We are able to invest in every sector. So we can pick up interesting, promising companies in every sector. In terms of, I would say, more tactical view, my advice would be to avoid companies that are too dependent from consumers. Why? Because I think that consumers will struggle in the quarters to come. It's just to highlight some 2 very simple charts. On the left-hand chart, you can see US savings rates. You know that consumers in the US and in Europe, it's the same story, have enjoyed pretty strong, I would say, excess savings. These savings are exhausted. It's not in next year. It's this winter, it will be finished. And above all, the consumer has some issues. In the US, it's the mortgage payment. It represents today close to 30% of their income. It's more than during the great financial crisis. So clearly, it's true that the consumer has been pretty strong today, but I do believe that it will be more difficult in the quarters to come. That's the reason why, in terms of asset allocation and sector allocation, we do prefer to be underweight on consumer staples and consumer discretionaries. Otherwise, I would advise to be pretty balanced between sectors. I don't want to be involved in growth or value names. In fact, once again, you could spot interesting stories in every sector. In telecom, in banks, in insurance, in energy, lots of interesting stories. So, in a nutshell, just to sum up this fund, yes, we have some awards. There's a typo in the presentation. In fact, we are 5-star Morningstar. We own the French, the Belgian, and the German SRI labels. I don't believe there's a German label in SR and SRI. And we have a pretty strong track record. But more important, we have a positive impact in terms of climate impact, for instance. We are a generalist fund, but today we are already aligned with the Paris Agreement, meaning we have a trajectory below the 2-degree scenario. And it is very important for your client to prove that you have a positive impact. We also have a positive impact on biodiversity. For me, biodiversity will be clearly the next ESG frontier. Just a figure to highlight. According to the World Economic Forum, 50% of our global economies is under threat from biodiversity loss. This is a staggering amount. On this fund, we have a biodiversity footprint 55% lower than our benchmark. So once again, we are able to prove that we have a positive impact on some key indicators. And just because I have two minutes time, I would like to emphasize a company that we do like in this portfolio, and we own for a very long period of time. It's Symrise. Symrise, that you may know, is an ingredients company. It's very interesting because it's an oligopoly along with Givaudan and the American IFF. These companies help lots of others, cosmetics, food, beverages, to improve their recipe. And you know that the consumer is looking for new recipes, more natural, more organic. And Symrise helps us to find this new formula. So, as you can imagine, these companies have pretty interesting growth looking forward. And as you can see, there's a little dog. It's a corgi in that slide. It's just to insist on one business of Symrise, because Symrise is involved in pet food. And pet food, as you may know, is a fantastic business model because, as you know, humans are completely crazy about their pets. It's a humanization of their pets. I have some very interesting figures in mind. 90% of people say they are part of their family, their pet. 34% say that it's their favorite child. And so humanization is, I would say, a structural trend. And just to finish on this slide, one of our PM, Alexis, visited what they call their pet food center, because Symrise has a pet food center in Brittany with almost 300 cats and dogs, and this is super interesting because they follow the dogs, their recipe, they use big data to monitor it. And just to say that this stock is a structural buy. We have some pushback recently, and we take advantage of that to add some new position. So I have finished. Thanks a lot for your attention, and see you after. Thank you.